How are you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options trading program. Let's get into Market Mondays for 6/20/2021. And the reason why we do Market Mondays, we want to give you a really brief summary of the markets, get you an understanding of how the markets can be beneficial to your life, but at the same time, not keep you here a long time with a really drawn out thing, because it's more about getting the information to you than about driving AdSense dollars. And there's nothing wrong with that if that's what you're doing, but we want to kind of brand ourselves as giving out people really concise information and getting up out of here. So what we want to ask you to do, give us a like, give us a share, give us a sub so you can continue to stay tapped into what we're doing. And let's go ahead and get into it. What we saw today is S&P was up around 1.4%, Dow up around 1.7%, NASDAQ up around 0.79%, 10-year Treasury is around 1.4%. So what we're seeing is that 10-year Treasury is down really low. A lot of times that can be very bullish for tech. We're seeing that 10-year Treasury start to walk itself down even more. You know, earlier this year was around 1.6, almost getting close to 1.7. What we want to look for this week is I think that Federal Reserve Powell and Treasury Secretary are going to be speaking about it, and maybe we're going to get an update on that particular conversation. And we're also going to get stress test results from the banks. That is going to be this Thursday, and we believe that could have some positive or negative, if the news is bad, influence on bank stocks. So that's not going to be a prediction. I'm not here to give you investment advice, but these are the things that we're going to kind of observe as we get ready to roll into June, but most importantly, kind of try to figure out how we're going to kind of set our summer up. Let's get into some of the jump outs. We're going to talk about companies that did well, may not have done well, and give you some context. So what we did was UBS, which is an investment bank, came out early this morning and they gave a downgrade to a sale to Rio Tinto Group, right? They said that the iron ore market is topped out. And what they mean by that is that they pretty much believe the iron ore market is at its peak. They believe, based on some of the market behavior in China, how they believe that they're going to continue to flood the commodities market. As a result, they believe iron ore has probably hit its top right now. And so they made this company a sell, and they haven't really given comment on other iron ore companies, but they specifically said that they forecasted that this company was a sell at its particular share price. Now, it came out today and it did not sell off. In fact, it went up, so it was up around 1.30. But what we want to do is continue to observe this to try to figure out in this particular sector of the market, is there going to be a sell off because people believe that it's hit its top and now we're in a position to take profit. And these are the kind of companies that people really don't talk about because, you know, in a lot of these channels, they want to attach a company to something that most people can understand, and the average American, especially the average investor, they really don't understand like the commodities market and really how big that is. You know, there's marketplaces where all they do all day is trade commodities. They don't even trade, you know, these regular S&P 500 stocks. So I want you to understand that this is a massive part of the world market. And so it's something that you can, you know, dedicate yourself to the understanding. It can be very lucrative for you. Now we're going to look at the S&P, the SPY. So, you know, S&P seasonality, over the 20 years, especially over the 5 years, show that we normally have a kind of really strong sell-off in the month of June. We didn't see that today. So what we have not seen yet is a really hard June sell-off for the S&P, which will be reflected in the SPY. So today it was up around 1.4%, came out of the gate really strong and just kept moving up. And so we got back over that 420 that we were using kind of like as a support for my weekend stock market wrap-up. And let's talk about NVDA. So NVDA is doing a stock split, I believe, in July, when the actual split is going to take place. And what we saw was over the past few days, they ran up really hard. And this morning they came out and they sold off really rapidly. And they kind of, wouldn't say recovered, but they, you know, kind of got back up over that 725, 720, got around that 730 and started to consolidate. So they closed the day around negative 1.3. There was around 4% almost earlier today. And we saw like, you know, it started to kind of reverse itself around 10:30 in the morning. So we saw a really strong sell off. It gapped down and started to sell off early. What we want to continue to observe is there's going to be a lot of volatility as they get closer to the stock split. I think the date of record for the stock split was today, but you can still, you know, if you own the shares by the day, but you can still, you know, it's still going to trade those shares as we get close to the stock split. So this is something that I'm really going to observe because I kind of remember what happened to Apple and Tesla after they split. I remember their run up and then I remember what happened after. So now that I've observed that, and this is something I tell people all the time, it's just like sports. So let's take football, for example. If we show you a play one time, right? We show you a play a second time. We're talking about people that's playing defense, right? So we're going to get rid of the formation, down the distance, all of that. We're going to make it real simple. If I show you a play the first time, right? I show you the play the second time. On the third time, do you have an idea just based on the setup, right? Based on the setup of the play, do you kind of have an idea what the person's trying to do? So if we understand that stock splits are not supposed to be bullish events, but we've seen with these particular companies that stock splits have been bullish events. And if they are bullish events, after the stock split finalizes and it concludes, what is the activity of the market after that? Right? So just like in football, we're going to simplify it. I want you to get rid of the formation. I want you to get rid of the down and distance. I want you to get rid of the personnel group. If they run a play on you twice in a row and they're successful at it, when you see that same play again, do you have an idea what's going on? Because a lot of what you see in the market is very similar to sports. It's a setup and they just run a setup. And it happens over and over and over and over again. And for some reason, it's like people don't recognize it, but it's the same setup. It's just in a different scenario. So it may not be exactly the same. It may not be identical, but it's a similar setup. So all I'm looking for in the video is that, do we get to see a really, really strong run up? Because we saw a strong run up earlier, but they're so far away from the actual stock split. What we may see is a lot of volatility, but what I'm going to look for is, as we get closer to the day of the split, are we going to see a lot of bullish behavior? And then after the split takes place, do we see a massive sell-off because it's moved up so fast and so rapidly? People are starting to look to take profit after the split. Now, what we're going to talk about is the topic of the day. Should you take a margin account? And what I mean by margin account is, if you're a trader, doesn't matter what you trade, you got a particular institution that you're trading through. They have access to capital through their relationships. And what can happen is, if your account gets to a large enough size, a lot of times they will offer you a margin account. So I've been offered a margin account a lot from different brokerages. Or you can go and request one. You know, you can just ask them, say, hey, look at my account, look at my trading behavior. Do you think I should get a margin account? And they may tell you, hey, we want you to deposit like another amount of money in the account. And then based on that, we can multiply based on, you know, kind of like the collateral that you put in. We just want you to make like a good faith deposit. Now, having a margin account, one, it creates liquidity for you. Big thing in this particular system that we live in, right, called capitalism, but it's not necessarily always capitalism. But in this market-based system that we live in, liquidity is really, really important, because you may want to make a move and you currently don't have the money to do it. And the move could be time sensitive. So I'm going to be real with you. If I could have had margin accounts, I could have made better moves in the market than what I'm currently making, because I operate on a cash account. I don't use a margin account. However, there's a downside to using a margin account. It's not your money, right? So if the account starts to go negative, or the particular people that you're working with don't kind of like some of your positions in the market, or, you know, the market may be going south and your whole account is red as a result, but you may think that it's going to turn around, but they may not. They can go into demand that you start liquidating everything. Why? Because it was their money in the first place. It's not yours, it's theirs. So they really can dictate to you the conditions, and it can be literally day to day. So one day everything could be cool. The next day they may have a problem with what's going on. And you can't be like, well, hey, I need y'all to let me stay in this scenario for another 2 weeks. They'd be like, nah, you know, we want you to exit out of these positions or we'll liquidate the account. And when you're operating through these particular institutions, you got to understand something. They have control over everything. Just because you got a login and a password don't mean anything, right? If they give you margin, they controlling that, not you. You're using that on their permission. They can evoke that permission at any time based on how they feel at that particular situation. And you, unlike one of these major hedge funds, you don't have real life relationships with them. They're not worried about future business with you. You're not operating that size of account. And you may think you have a big account. You can have $250,000 in an account. That's not a lot of money in this game. So, you know, it's different between a company that may be utilizing, you know, hundreds of millions in margin or some type of credit to operate. And the institution may be worried, well, if we cut them off, we will be cut off forever from doing business with them in the past. So we'll kind of let them go along till it gets really, really bad. And then we'll call that a margin account in. So it's something that you want to look into. It can help create what I call leverage, because now it can multiply your ability. And if you have a lot of conviction about a play, you can take a much larger position in not just trading, but also if you want to be a buy and hold person, take a much larger position as the situation starts to appreciate. You can pay back that margin. You can, you know, settle up with them and they'll start it all over again and give you more margin, because as long as you're paying the money back, they're going to continue to keep you with the liquidity. So it's something that you may want to consider, but you got to look at it from both sides. Always look at what the downside could be. And it's not negative thinking. It's just you want to kind of see what the whole scenario really is. right? So the same way they give you access to the liquidity, they can take it away. What are the conditions? How long do you have if they try to do a margin call on you? You know, how is this thing set up? Because like I said before, is that it's not your money, it's their money. And they will probably never give you so much money that they'll get themselves in trouble. It may get you in trouble, but it won't get them in trouble. So they're not going to give you like $40 million. What they can do is give you a few $1,000s up to maybe, if you got a big enough account, a few $1 million. And you can buy your margin. And like I said, as the situation starts to increase or appreciate, you just cash them back out and you do it all over again. And, you know, the real world of big business operates on credit. That's why I know people, if everything you've done, and this is myself included, I'm not trading a massive account. Why? Because I'm still operating on cash. If you start doing a certain scale of business, it's all done with credit lines anyway. That's just how it goes. So big traders, especially if you work for like prop firms, they do margin to facilitate your trading, and then they just make so much money per trade that you make, whether it's positive or negative, but they give you the liquidity that you can do to take larger positions. So as you start to expand your trading behavior, or in any real business, you're going to take on some level of margin or some level of credit, because it's going to allow you the liquidity to do what you want to do when you need to do it, as opposed to trying to figure out, you know, I'm operating on cash. So if I need to make a move in the market, but I don't have the money in my account, I got to transfer the money. Then I got to wait. It might take 8 hours. It might take 4 hours. You never know. Right. So I'm waiting on them. But by that time, the move can be over. Or I may not be able to take the position that I want to take, because I may see it first thing in the morning, but I don't have the actual liquidity in my account to take it. Then if I finally get it, it's 2 or 3 o'clock in the afternoon. My position has moved to where I say, well, you know what? It's not even worth it anymore, because I could have made so much money on this day move. I could have been in and out. So the market could sometimes move very fast on you where you need the liquidity. And that's why some people just have the margin. They just let it sit there just in case they need it for something, and they go ahead and move. But it takes a lot of discipline not to use that margin and use that liquidity on frivolous things, but just on things that you have a high amount of conviction over. So that's going to be Market Mondays for today. Like, share, subscribe. Hope you got some value from it. Do me a favor and share it out to somebody else that you know can get value from it. And if you feel like your whole network doesn't talk about the markets and they won't get any value from it, I would ask you to consider what type of people are you associating with, because a lot of times like-minded people move in the same direction. So find somebody in your network that can get value from this, or maybe consider the kind of people that you deal with, because I don't think this is like the same stuff as like maybe gossip content or he say, she say, or, you know, the gender war content. I feel like this is higher level content that can benefit you. So I hope you found value from it. If you got any questions, hit me up in the comments. This is David W. Williams, also known as Diamond Dave, and I'll talk to you later.